My God, the Fed held interest rates steady. But what does that mean? Why did they do that? Will it affect your life? What should you do with your money now? What are the best decisions? Stay tuned in to this video, I'll tell you. Don't forget to like, subscribe, and activate the bell to receive this information as soon as possible and always be up to date. Let's go to the video. So first part, let's understand the Fed decision. The Federal Reserve just wrapped up its latest meeting on May 7th, 2025. And as expected, they decided to keep interest rates right where they are, holding steady at 2.5% to 4.50%. This marks the third straight meeting without a rate change. And the reasoning behind it is a bit of a high-stakes balancing act. And why the Fed hit pause? Again, the Fed is walking a tightrope right now. On the one hand, inflation is still a concern, but on the other, the economy is showing some real signs of slowing down. GDP growth projections for 2025 have been cut to 1.7%, down from the 2.1% they predicted just a few months ago. That's not great news. Plus, the Fed is expecting unemployment to creep up to 4.4% by the end of the year, up from the current 4.1%. On top of that, the core inflation, Fed's favorite inflation gauge, is now projected to hit 2.8% by year's end, a jump from the 2.5% they previously expected. So, yeah, prices aren't cooling as fast as they'd like, which means they can't cut rates without risking another inflation surge. Making things even more complicated is the recent trade drama. President Trump just slapped a massive 145% tariff on Chinese imports and a 10% baseline tariff on most other imports. That's not just a small tweak, it's a massive shakeup in the global trade game. And you probably know that. These tariffs might help some domestic manufacturers in the short run, but they're also driving up costs for businesses and consumers, which could stoke even more inflation. And while the White House argues that these tariffs will bring back manufacturing jobs and cut the trade deficit, a lot of economists are raising their eyebrows, warning that this kind of aggressive trade policy could lead to stagflation, a nasty mix of stagnant growth and rising prices. Also, President Trump is ramping up pressure on the Federal Reserve / interest rates, pushing aggressively a rate cut to counterbalance the economic impact of his newly imposed tariffs. Trump's reasoning: lower rates could ease borrowing costs, stimulate consumer spending, support U.S. businesses grappling with soaring import prices. Essentially, he's looking to mitigate potential fallout from his bold trade strategy, aiming to bolster economic growth ahead of crucial elections, even if it clashes with the Fed's cautious inflation-focused approach. Fed Chair Jerome Powell took the mic after the decision, and while he tried to stay upbeat, he made it clear that the Fed is playing it cautious. He emphasized that they need more data before making any major moves and that the path forward isn't as straightforward as they'd like. Powell's message: don't expect a rate cut anytime soon. They're laser focused on avoiding a repeat of the 1970s inflation nightmare. Wall Street's reaction was a mixed bag. The S&P 500 ticked up 0.4%, closing at 5,631.28, and the Dow added 0.7% to hit 41,113.97, while the Nasdaq edged up 0.3% to 17,738.16. It's a decent bounce, but overall, markets are still down for the week, reflecting the broader uncertainty hanging over the economy. Well, that said, let's move to the second part: what to do with your money. Well, the first question I really need to answer before thinking what to do with my money is, should I be worried about a crisis? Look, let's cut right to it. There's definitely reason to stay alert, but not panic. The economy shrank 0.3% in Q1 2025, marking its first contraction in 3 years, mainly driven by increased imports and lower government spending. And those massive new tariffs, like Trump's recent 145% on Chinese imports, are tossing gasoline onto an already tricky fire, driving costs higher for businesses and consumers alike. Economists are whispering about stagflation, a nightmare scenario where prices keep climbing while growth grinds to a halt. Consumer confidence dropped sharply to 86.0, the lowest since May 2020, as folks become increasingly uneasy. But here's the reality check: we're not seeing the catastrophic signals that scream full-blown crisis, at least not yet. Employment's holding steady at 4.2%, and despite pressures, businesses are generally managing. Bottom line, stay cautious, not terrified. Stay smart, pay down debt, build your cash cushion, and diversify your investments. Preparedness beats panic every single time. And what does that mean in practice? First up, your savings accounts are still golden. Online banks are shelling out some sweet returns, hovering around 5% APY. Seriously, if your cash is still parked at some old school bank earning peanuts, it's time to make the switch and watch your emergency fund finally grow. I gave some options in the last video of the channel. You can watch it. But there's another thing you can take advantage of at this time: U.S. Treasuries. The 10-year Treasury yield is hovering around 4.25% to 4.5%, which, trust me, is pretty high compared to recent history. Over the past 15 years, yields usually floated between just 1% and 3% about 70% of the time. This moment is like catching your favorite brand on a rare sale. You're locking in returns way above the historical average. But here's where things get cool. There's something called mark-to-market risk. Basically, bond prices move daily, reflecting reflecting current interest rates. Think of it this way. If rates drop after you've bought your bond suddenly becomes a hot ticket, increasing in market value because it pays more interest than new bonds issued at lower rates. Imagine you bought a collectible car. If production stops or the car gets wildly popular, its market value shoots up, even though it's still the exact same car sitting in your garage. Here's how this plays out in real life. Suppose you buy a 10-year Treasury at today's 4.5% rate. If a year from now, rates dip to 3.5%, your bond's market value could jump around 9% due to its higher yield and remaining duration. In practical terms, your $10,000 investment could grow to about $10,900. And I'm not even counting the steady interest you've been pocketing along the way. This return in a really safe investment is wild, and it can be higher if you invest in a 30-year option that is hovering around 4.8%. Also, let's not forget about emergency funds. Treasuries, backed fully by Uncle Sam, are among the safest assets out there. This security means you'll have reliable cash ready when the market tanks and stocks or real estate suddenly go on sale. Having that liquidity positions you perfectly to snap up opportunities exactly when prices drop. Buying US Treasuries right now means locking in solid returns and strategically setting yourself up for future market moves, giving you financial flexibility and peace of mind. Well, that's it, cousins. Thanks for watching until the end. Stay invested until the next video.